Yeah, thank you. Let's move on to the next article we have. Here's how mortgage rates have changed during the Fed hike. This is coming in from Forbes. We don't often talk about Forbes, but I saw this article I wanted to bring up to you, Brian. After hovering at record low of below 3% for much of 2020 and 2021, 30-year fixed rates have shot as high as 7.8% last fall. Ding, ding, ding. October of 2023. Hey. It has more than doubled home loan borrowing costs that have coincided with the Fed's dramatic shift in Fed funds rate. The Fed, back when this started in March of 2022, before they started hiking rates, the Fed was at 0.5%, and now are at the 5.25 to 5.5%. And has ended rate hikes as of last summer, but man, the ripple effects are painful.
So how much further will mortgage rates go down?
They are going to go down. I mean, you can see the chart. We'll probably flash. You know what? Let's flash the chart on the screen right now. You can see the correlation between mortgage rates in general, or average, and the Fed funds rate.
I wanted to go through a few points that they signaled, they mentioned here.
Talk about that.
The Fed wants 2.5 federal fund rate in the long run. Now, Goldman Sachs came back and said, I think it'll be closer to 3.25 to 3.5% due to lingering inflation, which we have been, the Fed, mentioning that time and time again, still not making their 100% decision, but they say inflation is still afloat. And then historically, rates sit about 2% higher than the 10-year Treasury bond, which highly correlates with the direction that the federal fund rate wants to move rates. So I feel that in the next coming months, maybe into 2025, rates aren't going to tank down to your 2%.
No, they can't. I mean,
at all.
You're already citing that the Fed wants to. They expect rates to go return to 2.5%. I think that's a little projection.
That is.
It's a big projection. Let's be honest. But here's the thing: if we're already at, let's say, 5.25 to 5.5. What is going to cause you to have a 3% swing to the downside? And if you do march it down, then that's going to be marched down over the same period of time we marched back up.
Yeah.
Because we marched up over 18, 20 months, you're going to march back down. Because if you just dunk it, that does have economic repercussions
100%,
right away. And part of what is being cited here by Goldman Sachs is the lingering inflation. I wrote here, inflated prices are now embedded. They just are. I don't know that people are going to agree with me. People that currently love what's happening in 2024 are probably going to be like, yeah, no problem. It's just the way it is.
Good.
And people that are like super angry about 2024 are going to be like, we're pissed off. Inflation sucks and it's never going anywhere. I'm just saying, mechanically speaking, inflation is embedded.
Yeah.
There are, I don't think any service or product I pay for is the same price or lower than it has in its peak. Now, if people are going to argue, oh, it's gone down. No. The rate of increase has slowed. Do not confuse that with a negative sign in front of the number, which would indicate going down.
Yeah.
So don't at me, oh, it was only 0.3 and now it's 0.1. No, that's still plus territory. Get it right. Understand how it works. It's cumulative compounding over time. It's not in decline unless there's a negative number in front of it and a negative sign in front of the number. Okay?
100%. We're wrapped. Done.
So here's the thing. So, closing out this part. So Goldman's projections about the 30-year mortgage rate, it is in conjunction with the 10-year yield. You can see it on the chart that there's this Fed funds rate marching up. Mortgage rates have marched up. And it said here, Goldman projections imply 30-year mortgage rates are likely to settle somewhere close to 5% when the Fed concludes its current cycle. From 2011 to 2022, mortgage rates never topped 5%. I'm sorry, Brian, real quick. How many years is that? 11. 11 years. From 2011 to 2022, mortgage rates never topped 5%. And now we're not even anywhere close to that unless you're talking about some certain government loans with down payments and all sorts of things. But
that's
they're citing, an 11-year time frame. I don't know that we have 11 years to wait. And
so you tell me in another 11 years, we'll see rates come right back down.
Yeah.
Ladies, thank you.
Come back in 2035 and let's see if we were right.
So unless there's another catastrophic event like a black swan or something that I've constantly been hearing throughout the news and people kind of lingering, I don't know. But I am going to agree, and I think rates will drop to around 4.5% to 6% because I think that's a healthy, it's somewhere where it doesn't build up so much demand that it's literally just, chaos. But at the same time, everybody has a different tier. Some people are okay at 6%. Some people are okay at 4%. Some people, unfortunately, need to be at 2%. But then that comes at a different problem. Maybe your income needs to go up. Maybe your situation is a little bit different. Your debt needs to be shaved down. So there's a tier for everybody. I just don't think that 2%, 1%, even low 3% is something that's going to be healthy for, the market, because then we just see all this bent up demand. And then we go right back to high prices, high demand. We go madness.
It's going to ease certain things when it comes to credit, lines of credit,
Yeah,
business credit.
yeah.
And it eases up some of those things. It maybe like we'll take the chokehold off the neck of employment, that kind of thing. But there is a sweet spot where demand and supply can kind of come into agreement with one another. We're just not there yet.
Yeah.
And the Fed.
Fortunately.
Here's the weird thing: is that all things real estate related right now, the commission lawsuit and insurance is taking front and center when you think it'd be the Fed, but it's not. The Fed is like easily in third place at best.
They're kind of like, oh, thank God.
They are certainly not number 1 and 2 right now. So,
which is alarming because if that's not the most important thing, like, we got bigger problems here.